Do stock market crashes matter? Yes, and no, and yes, in that order.
U.S. tariffs rattling investors, sparking dramatic losses.
Global financial markets are tanking again.
Looking just at the S&P 500, the top 500 companies on American stock exchanges, we can see how trading ended at exactly 4 p.m. Eastern on April 2nd. That is to say, up slightly. Then at 4:05 p.m. Eastern,
I will sign a historic executive order instituting reciprocal tariffs on countries throughout the world. Reciprocal, that means they do it to us and we do it to them.
And the very next morning, the index plunges 5%, which might not sound like a lot, but on an index worth $50 trillion, 5% is a couple $1 trillion, and stock value gone. The next day, things go from bad to worse. The S&P down 6%. Again, that's another couple $1 trillion in value wiped out. So when the U.S. Treasury Secretary goes on NBC's Meet the Press and says,
look, we get these short-term market reactions from time to time.
And this after going on the same program a couple of weeks earlier, saying,
I'm not worried about the markets. I say that one week does not the market make.
But then he faces a question like,
what is your message to Americans who want to retire right now and who've just seen their lifetime savings drop significantly?
Well, which point of view is the correct one? This will blow over, or this is a full-blown crisis? We can figure this out.
Is there pain in the market? At some point, you're unwilling to tolerate this idea of a Trump put. Is there a threshold?
I think your question is so stupid. I mean, I think it's I don't want anything to go down, but sometimes you have to take medicine to fix something.
So this first point might come off as a bit obvious, but I promise there's very good reason to start so simple. And that is just to say that the people most directly affected by a stock market crash are the people who hold those stocks that crashed. And who holds those stocks? Well, let me show you the latest Federal Reserve data from the fourth quarter last year. Who owns which stocks? The top 0.1% of wealthiest Americans, they owned almost a quarter of all U.S. stocks and mutual funds, which should already blow your mind. But let's continue. Because if we broaden this out a little, let's look at the top 1% of wealthiest Americans. They owned exactly half of the stock market. And the top 10%, well, now we're talking almost the whole damn pie, 87.2% of all U.S. stocks. The next bunch of people, let's call them the well-off, they own 11.7% of all stocks. And the bottom half of America, by wealth, their piece of the pie is 1%.
Ownership of stocks is highly skewed towards wealthy individuals. So the biggest effects are going to be at the top of the income distribution.
And keep in mind, no matter which income group you're in, losses on the stock market only become real when you cash out, when you sell low. And that's why the people who most successfully weather these fluctuations tend to keep one simple truth in mind.
The reason the stock market is considered a good investment is because it's a long-term investment. If you look day to day, week to week, it's very risky. Over the long term, it's a good investment.
So in other words, shame on you for buying that 1999 Shadowless First Edition holographic base set Charizard for $8,000 all those years ago and seeing the price plummet to $2,000 when all the Pokemon hype died off, and so you sold this in a panic. Because you should have known that you would be able to sell it later for $420,000 when people started caring about these things again. Yes, that really happened. But again, losses on paper become real losses only when you sell. So what's the problem then?
If you exclude the uber wealthy and the extreme low end of the income distribution, then everybody in the middle is going to be affected to some extent. It's just whether it's directly in their face because they can see it in their Ameritrade account, or whether they see it indirectly with an annual statement coming from their employer in the company pension plan. But they are tied up in the stock market in some capacity.
Working Americans, working Canadians rely on those pensions to deliver them the retirement that they have worked for their entire lives. So it's easy to get caught up in stock markets are only for rich people and stocks are only something used by and empowered by rich people. It's not true.
Yes, according to recent surveys, most Americans, about 2/3, have some kind of exposure to the stock market. And a big part of that is through pensions. So yes, this is where you get into the panic-inducing headlines, suggesting people's retirement nest eggs are just getting absolutely obliterated by all of this stock market chaos. Because surely a big 10% drop in markets would affect people's pensions in the same way. Or maybe not.
I think that's a false narrative. Americans who want to retire right now, the Americans who have put away for years in their savings accounts, I think they don't look at the day-to-day fluctuations of what's happening.
And to some extent, Secretary Bessent is right.
Typically, a financial planner would tell you that, as you approach your retirement, you should start to change the mix of what you hold from equities that tend to be riskier and more volatile to bonds, which, tend to hold their value better.
Yes, if you're invested in a fund managed by a professional, what's typically happening is the closer you get to retirement, the more your portfolio is shifting from risky corporate stocks and more towards safer investments like bonds and money markets that generally, make less money during good times, but they also lose less during bad times. So for a lot of people, they're simply not exposed to the market in a way where they would feel a one-to-one loss. Like for every dollar the market loses, they're not necessarily losing a dollar as well.
In fact, most Americans don't have everything in the market. Most Americans in a 401k have what's called a 60-40 account.
A 60-40 account simply being a spread of 60% stocks, 40% bonds.
Or down 5 or 6% on the year. People have a long-term view.
Now, let's pause, because the point Bessent is trying to make here is that as bad as the markets look, most Americans may not be feeling the hit quite so hard. But there's still a hit, right?
The fact is that you're still exposed on some level to the movements of the stock market because you're still going to hold some amount of equities. And even if they're just the blue blood shares, the ones that are rock solid, we've seen that no sector has been spared in this increasing tariff war.
People who are on the sort of the cusp of that life moment that demands this savings, whether it's retirement, whether or not it's education, whether or not you've been saving up to buy a new car or something like that. Any savings you've been accumulated, suddenly you just took a big step back.
At this point, I can actually show you this chart from US Bank. Two hypothetical cases where the blue line up here is a guy who retired during a market upturn, and the green line is someone who retired during a market downturn. So in the first 3 years of this chart, the blue guy's pot is growing, whereas our poor green guy, his pot is shrinking for 3 years. And importantly, after the first 3 years, their markets even out, and they're both posting identical returns. But look how much farther the blue guy's money goes. It lasts 40 years before running out. The green guy, his money barely lasts 25.
So you're going to find that some of that wealth has been wiped out. Even if you lost 2.5%, which is much less than what the market correction has been so far, that 2.5% on 40 years of accumulated wealth is essentially 1 year's worth of contributions. That means that if you're 5 years from retirement, you now need 6 years, assuming that the market doesn't recover, to make that money back for you. That's an extra 20% onto your working life at this point.
There are people who will find themselves in a position right now, this week, that their timing is just such that they need to pull that money out, and they're going to face a loss. And that's catastrophic for them. That's catastrophic for their investments, their families, their retirement plans.
So is what we've seen just one big blip in the market? Who knows? Does it spell outright doom for anyone exposed? Maybe not. But if this goes on, if stock markets continue to struggle, might there be a larger cumulative compounding impact? The answer is yes. So do stock market crashes matter? Like I said at the start, yes, because people buy and sell those stocks, but also no, because not everyone's invested the same way, and even those who are might not be experiencing quite such dramatic losses. But crashes do matter, because what's worth remembering is that stock markets, even though we kind of talk about them this way, they're not some completely independent construct that rich people gamble their money on. Markets are a reflection of what's happening in the real world. I like to think of stock markets the same way I think of looking at a mirror. So, if I wake up one morning and I look like hell and I go over to my bathroom mirror and I say, oh my God, what the hell happened to that guy? I'm not so much concerned about the mirror, right? I'm worried about what the mirror is telling me about the person standing in front of it. The stock market's the same way. It reflects real hardship, real pain felt at a business level, which then filters down to literally everybody.
The stock market is, in a way, a barometer of that uncertainty. And so I would think of it more as the causes as coming from the economic uncertainty to the stock market. But then the fall in the stock market itself kind of propagates the problem.
What's going on in the background is investors are dialing down their expectation with the profit outlook dimming. What firms will do is they'll start layoffs or some cost-cutting measure.
If business confidence is down, do you want to build a new factory? Do you want to replace your equipment? Do you want to invest in new technology? Do you want to hire more people? The answer to those questions is probably no as well.
They're certainly not going to expand and add that new fleet of trucks or that new warehouse or that new capital expenditure they're looking at. And that too will bleed into the real life economy of everyday people.
This is what economists believe is the real problem when markets crash.
The thought of a recession or even a global recession is not that impossible to imagine right now.
Because does it cause pain in the short term for some people? Absolutely it does. And I don't want to minimize that. But the forest for the trees, so to speak, is that the stock market is an indicator. And sharp downturns can either be short-term anomalies or they can signal big, big problems.